Right now, 84 million American homeowners carry an active mortgage, and the vast majority have no idea what happens to that debt the moment they stop breathing. Here's what doesn't happen. It doesn't disappear. It doesn't get forgiven, and it doesn't quietly settle itself inside your estate. What actually happens is far worse. Your family inherits a financial grenade with a fuse measured in months, not years. The average remaining mortgage balance in the U.S. sits at $244,000. But when you add late penalties, legal fees, forced sales, and lost equity, your heirs face a total cost averaging $287,000. This is the inheritance trap that destroys families. And today, we're diffusing it step by step. The second a homeowner dies, the mortgage doesn't pause. Interest keeps accruing. Monthly payments keep coming due. And here's what catches most families off guard: the lender doesn't stop anything out of sympathy. According to the Consumer Financial Protection Bureau, servicers are required to work with confirmed successors, but that process takes weeks to even initiate. Meanwhile, the 30-day payment clock is already ticking. If your name is the only one on the mortgage, your family can't even access the loan account without a death certificate, a probate filing, and in many states, a court-appointed executor. Miss 2 or 3 payments during that legal scramble, and your family's credit starts cratering. The home your parents spent 30 years paying off is suddenly sliding toward foreclosure, not because anyone did anything wrong, but because nobody planned for this exact moment. Buried in the fine print of virtually every mortgage written in the last 40 years is something called a due-on-sale clause. It sounds harmless. It's not. This clause gives the lender the legal right to demand full repayment of the entire remaining balance the moment the property changes hands. Sell it, transfer it, inherit it, the clause technically triggers. So when a parent dies and the home passes to a child, the bank can theoretically call the entire loan due immediately. We're talking $200,000, $300,000, $400,000 payable in full. Most families don't have that kind of cash, which means the bank's nuclear option becomes a forced sale. The family home gone. The equity your parents built over decades split between realtors, attorneys, and closing costs. But here's where it gets interesting. There's a federal law that most lenders hope you never discover. In 1982, Congress passed the Garn-St, Germain Depository Institutions Act. It's one of the most powerful homeowner protections in federal law, and almost nobody talks about it. Here's what it does. The Garn-St, Germain Act explicitly prohibits lenders from enforcing the due-on-sale clause when a property transfers to a relative after the borrower's death. If you inherit your parents' home, the bank cannot call the loan due. They cannot accelerate the balance. They cannot force you to refinance. The mortgage stays exactly as it is, same rate, same terms, same monthly payment. This applies to spouses, children, and other relatives who inherit the property. The only catch: you generally need to occupy the home or intend to, but even that requirement has been loosely enforced by courts. The problem is most families don't know this law exists, and some lenders, let's be honest, aren't exactly rushing to remind them. So you've inherited a home with a mortgage. Garn-St, Germain protects you. Now what? You need to formally assume the loan, and this is where the process gets frustrating. First, contact the servicer with a death certificate and proof you're a legal heir, typically through probate or a trust document. The servicer is supposed to recognize you as a successor in interest. The CFPB updated its rules in 2016 to require servicers to provide successors with the same loss mitigation options available to original borrowers. That means loan modifications, forbearance, and repayment plans are all on the table. But here's the reality on the ground. According to a 2023 National Consumer Law Center report, nearly 40% of heirs reported significant difficulty getting servicers to cooperate. Calls go unanswered. Documents get lost. Payments get rejected because the name on the check doesn't match the name on the loan. The system works, but only if you push through the bureaucratic wall with documentation in hand. If the due-on-sale clause is a hidden trap, reverse mortgages are an open pit. When a homeowner with a reverse mortgage dies, the entire loan balance becomes due, usually within 6 months with a possible extension to 12. And unlike a traditional mortgage, that balance has been growing every single month the borrower was alive. A homeowner who took out a reverse mortgage for $150,000 at age 65 could easily owe $300,000 by age 80. The equity they thought they were preserving, consumed by compounding interest and mortgage insurance premiums. According to the Department of Housing and Urban Development, over 18% of reverse mortgage borrowers' estates end up owing more than the home is worth. The heirs face a brutal choice: pay off the inflated balance, hand the keys back to the lender, or sell the home knowing every dollar of equity has already been eaten. For families counting on that inheritance, a reverse mortgage can feel like a betrayal discovered too late. Let's break down exactly where that $287,000 figure comes from, because it's not just the mortgage balance. Start with the average remaining balance, $244,000. Add probate legal fees, which typically run 3 to 7% of the estate value. On a $400,000 home, that's $12,000 to $28,000 gone to attorneys alone. Then add 3 to 6 months of missed mortgage payments while probate grinds through the courts. Another $5,000 to $12,000 in arrears plus late fees, property maintenance, insurance, and property taxes during that limbo period. Another $4,000 to $8,000. And if the home goes to a forced sale, you're losing 6% to real estate commissions plus closing costs. Another $25,000 to $30,000. Stack it all up, and the total cost to heirs lands in that $287,000 range. The mortgage itself is only part of the damage. The real killer is the cascade of costs that hits when nobody has a plan. The most straightforward way to defuse this entire situation is life insurance. A term policy large enough to cover the remaining mortgage balance ensures your heirs can pay off the loan immediately. No probate delays, no assumption headaches, no forced sales. A healthy 40-year-old can get a $500,000 20-year term policy for roughly $30 a month. That's the cost of a single streaming subscription to protect a $500,000 asset. But here's where people mess it up. They buy a policy early, then never update it. 20 years later, they've refinanced twice, moved to a bigger home, and their coverage doesn't come close to matching their current balance. Or worse, they name their estate as the beneficiary instead of a specific person, which drags the payout straight into probate and defeats the entire purpose. The fix is simple. Review your coverage every time you refinance or move. Name a specific human being as your beneficiary. And make sure whoever inherits the home knows the policy exists and exactly where to find it. If life insurance is the shield, a revocable living trust is the escape tunnel. When you place your home in a trust, it passes directly to your beneficiaries when you die, completely bypassing probate. No court proceedings, no executor appointments, no 6-month delays while the mortgage payment clock keeps ticking. And here's the critical part, the Garn-St. Germain Act explicitly covers transfers into trusts where the borrower is a beneficiary. So your lender cannot trigger the due-on-sale clause when you move your home into a revocable living trust. Setting one up typically costs between $1,500 and $3,000 with an estate attorney. Compare that to probate costs that can hit $20,000 to $30,000 on a larger estate. The math is overwhelming. But according to a 2024 CaringCom survey, only 33% of Americans have any estate plan at all. Among homeowners carrying active mortgages, the number drops even lower. A trust takes a few hours to set up. Probate takes 6 to 18 months. That's not a close call. Here's what makes all of this so dangerous: the timeline mismatch. Probate doesn't move at the speed of mortgage payments. The average probate process in America takes 12 to 18 months. In states like California and New York, contested estates can drag on for 2 to 3 years. Meanwhile, that mortgage payment is due on the first of every single month. Most lenders will give heirs some runway, typically 90 to 120 days before initiating foreclosure. But the CFPB has documented cases where servicers began foreclosure proceedings in as little as 60 days after the borrower's death. And during active probate, the estate is effectively frozen. Heirs often can't sell the property, refinance the mortgage, or even access the deceased's bank accounts to make payments. It's a system where two clocks are running at completely different speeds, and families get crushed in the gap between them. Here's your action plan, 5 steps, and none of them are complicated. Step 1, get a term life insurance policy that covers at least your remaining mortgage balance. If you're healthy, this could cost less than $1 a day. Do it this week. Step 2, set up a revocable living trust and transfer your home into it. Yes, it costs $1,500 to $3,000. That's roughly 1% of what probate would cost your family. Step 3, check if your state offers a transfer-on-death deed. 29 states now have this option. It's a simple document that names who gets the property when you die, no probate required, and it costs almost nothing to file. Step 4, create a physical and digital document your heirs can actually find. Include the mortgage servicer's phone number, your insurance policy numbers, the trust documents, and a clear explanation of what to do first. Step 5, review everything every 2 years or after any major life event. Refinance, remarriage, new child, new home. Any of these can invalidate your plan if you don't update it. 5 steps, a few hours of your time, and your family never has to face the inheritance trap. Your mortgage is probably the largest debt you'll ever carry. Don't let it become the largest burden your family ever faces. If this breakdown gave you even one strategy you didn't know about, send it to someone who owns a home, because they probably need to hear this. And if you want more strategies that protect your wealth and your family from the financial blind spots nobody talks about, subscribe. We'll keep breaking them down.